In March 2023, a bank managing over $200 billion simply stopped existing in less than 48 hours. Not because it secretly ran out of money, but because a single announcement triggered the fastest bank run in modern history, all through a few phone taps. This is the story of Silicon Valley Bank and how trust can disappear faster than any number on a balance sheet. For years, Silicon Valley Bank was the go-to bank for tech startups and venture capital firms. Nearly half of all venture-backed startups in the United States banked here. If you were building a startup in Silicon Valley, chances are your company's entire operating cash, including the money set aside for payroll, sat in this one bank. During the years of near zero interest rates, the bank took billions of dollars in customer deposits and parked them into long term government bonds, seen as one of the safest investments in the world. But there was a hidden problem. When interest rates rise, the market value of older, lower interest bonds falls. Starting in 2022, the Federal Reserve raised interest rates faster than almost any point in decades, and the value of those safe bonds quietly sank. On paper, Silicon Valley Bank was sitting on billions of dollars in unrealized losses. On March 8, 2023, the bank admitted it. It had sold a chunk of those bonds at a real loss and needed to raise $2.25 billion to shore up its balance sheet. For most banks, that kind of announcement might cause a small ripple. For this bank, it caused a tidal wave. Its customers weren't ordinary savers, they were startup founders and venture capitalists, tightly connected through group chats and social media, many holding far more than the insured limit in their accounts. Within hours, investors were telling their own portfolio companies to pull their money out immediately. Compare that to a bank run 100 years ago. Back then, word spread slowly, and pulling your money out meant physically standing in a line outside a branch, sometimes for days. This time, nobody needed to stand anywhere. Withdrawals happened with a few taps on a phone, from a coffee shop, from bed, from anywhere with signal. In a single day, customers tried to pull out around $42 billion. No bank on earth is built to survive that kind of speed. Founders openly panicked about a very real problem: how they were going to pay their own employees in a few days if their cash stayed frozen. By March 10th, regulators stepped in and shut the bank down. It became the second largest bank failure in United States history, and it took less time to collapse than most people take to plan a weekend trip. The fear didn't stop there. Days later, Signature Bank, another lender with a similarly concentrated customer base, collapsed under the same kind of panic. Regulators took the extraordinary step of guaranteeing deposits far beyond the normal insurance limit just to stop the fear from spreading to every other regional bank in the country. It worked, but only barely. What remained of Silicon Valley Bank was later bought up by First Citizens Bank, and the name that once defined an entire industry quietly disappeared. Silicon Valley Bank didn't fail because the money vanished. It failed because thousands of people lost trust within the same few hours, and modern banking let them act on that fear instantly. The real lesson isn't just about one bank, it's about knowing your own insured limits and never keeping all your eggs in one basket, no matter how safe that basket looks. If this helped you understand how fast trust in money can break, subscribe for more stories like this. I'll see you in the next one.